It's Wednesday, 2nd of October. This is a special Capital Economics Weekly briefing. I'm David Wilder. I'm joined by Deputy Chief EM Economist Jason Tuvey and by David Oxley, who is the head of our Commodities and Climate coverage. We're speaking about 9:15 London, that's 11:15 Israel, 11:45 in Iran. We're speaking after Iran fired more than 180 missiles at Israel on Tuesday night. The Israeli government has vowed to respond. Oil spiked as news spread of the impending strike on Tuesday. David, where is the market now?
Well, it's a lot higher than it was yesterday morning, to put it bluntly. So predictably, the oil price reacted sharply to the news of the imminent strike yesterday. The intraday swing in the oil price, which had actually fallen in trading yesterday morning. It was the largest we've seen this year. Crucially, this hasn't dissipated today. Actually, oil prices are up another 2% or so this morning. So they're currently sitting around $75 per barrel, which is about 7% higher than they were this time yesterday.
Jason, what comes next? I mean, it's become a cliche at every lurch in this crisis to say this marks a serious escalation. So I'll avoid that, but bearing in mind that we're not military strategists or geopolitical scientists, what are the macro and market implications here? What kind of advice are we giving clients?
Yeah, I think obviously since the attack, Iran has offered a path towards de-escalation. It said that its action is concluded unless there is retaliation by Israel, in which case it said its response would be stronger and more powerful. I guess now all eyes are on Israel and what it does. We've seen Prime Minister Netanyahu say that Iran will pay. There's been more troops, Israeli troops sent to Lebanon. So I guess the question is, does Israel now attack Iran directly? That has certainly been the speculation. Talk that it may try to threaten Iran's nuclear facilities in particular. So that's where we are. It's all eyes on Israel at this stage. And then obviously if Israel does decide to escalate back to Iran, I guess.
Talk about how Iranian oil fits into the global supply picture. As you say, there have been briefings to the press about potential strikes on Iranian oil facilities if Iran went ahead with this missile strike on Tuesday. What does that mean in terms of global output if there was this Israeli retaliation?
Yeah, so Iran's oil output is actually pretty small in the grand scheme of things. It's about 4% of global output. So it wouldn't be a major issue for the oil market, but yeah, any disruption would be unwelcome. Clearly, one thing to bear in mind within all of this is what's happening with OPEC right now. We've seen in the past week or so, Saudi Arabia say that it's looking to increase production. And so if Iranian supplies were disrupted, we suspect that Saudi Arabia and other members of OPEC might look to step in and increase their supply to the market. And it's worth bearing in mind that Saudi has quite a lot of spare capacity right now. Its production is very low compared to what it could produce at. So it could quite easily offset any loss of Iranian oil output. I guess the big unknown really is if Iran were to try to close the Strait of Hormuz. The Strait of Hormuz is a very important motorway for the energy market. Obviously, a lot of the oil and gas from the Gulf countries is shipped via the strait. So any disruption would be particularly disruptive for global energy markets. I think we're a bit sceptical of that. And there's a question mark over how long that Iran would be able to do that for, given the US and its allies would probably move quite quickly to unblock the strait. There's other reasons to think the impact on the energy market might be quite limited. For example, ships carrying Qatari gas, for example, might be allowed through simply because of the fairly warm relations between Iran and Qatar. And also worth bearing in mind that the likes of Saudi and the UAE have built pipelines in recent years that mean they are not so reliant on the Strait of Hormuz to ship their oil.
David, what happens now in terms of prices based on everything we know? I'm conscious we're days away from the US September employment report. As Jason said, we've had reports that the Saudis are willing to increase production. Where do we see prices going from here?
Well, I think in the very near term, it's all risk premium, really. There's been a lot of discussion about just how muted energy markets have been to developments in the Middle East recently. I think what we saw yesterday, that's not completely cut and shut. There's certainly the potential for this risk premium to spike higher in the near term were geopolitical developments to take a turn for the worse. As you said earlier, we're not geopolitical experts in this respect, and it's very hard to gauge. I think the other thing that's worth bearing in mind, though, is that all of this, if you strip out the risk premium, there's a big question marks about the fundamental side of the market too. Obviously, the key question on the back of this escalation is, as Jason alluded to earlier, in regards to what happens to Iranian production and whether its facilities to export are damaged during any escalation. The big question mark there is over, how quickly or whether OPEC, with the large amount of spare capacity they currently have, would step in to fill that in the event that some of that capacity were to fall offline. But the other question, big question marks, as you said, about the strength of global demand more generally, is another thing that is playing out in the background of all of this stuff, particularly against the backdrop of weak demand in China and obviously what the stimulus efforts are going to mean for that. So I think, at the minute, this is all risk premium, certainly the potential for it to spike higher, but depending on how things develop, the attention could soon turn back to the fundamentals for oil, which are not incredibly supportive. For what it's worth, even after the 7% or so rise in oil prices over the last day, prices are only back to where they were at the start of last week and well below the average that they were in Q3. Our end year forecast for this year is basically at $75, so bang on the nose where we are now. At this stage, we are not changing our forecast for prices to ease back to $70 by the end of next year, and then we've got 60 in for the end of 2026, which, as I say, is more driven by the fundamentals of OPEC bringing more supply on over the longer term and weakening demand dynamics elsewhere in the world, particularly China.
Final question, inflation, the inflation genie, if it's not back in the bottle, it certainly seems to be heading quickly back into the bottle. Is there anything that we are seeing here with this situation that could present an upside risk to the inflation picture?
Well, it's certainly not helpful. A rough rule of thumb is that a 5% increase in oil prices adds about 0.1 percentage points to headline inflation in advanced economies. So, not helpful, but equally, as things stand, what we've seen is probably not sufficiently large enough to have a bearing on central bank policy right now. Obviously, things could change if oil prices were to rise further, up to $90 per barrel would be the sort of territory where that would start to have a bigger bearing on policy. But crucially, it would also be how long this is sustained for. So this, for it to really move the needle in central banks. So, for that to happen, we'd really have to see a much bigger escalation in hostilities than what we've seen so far.
David Oxley and Jason Tuvey talking about the situation in the Middle East, its impact on oil markets and what it means for the global inflation picture. I'll post our latest analysis of the situation in the podcast notes. We are, of course, staying on top of the situation. We will bring you the latest analysis as this situation develops. Until next time, goodbye. Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.